Okay, everybody, this is Patrick Zielbauer from Infinity Futures. Welcome. Thanks for coming to the event here today. It is Friday, March 16th at 9 a.m. Central Time. Let's go through some risk stuff, and then we will get right into it with Jonathan. Trading futures, options on futures, and retail off-exchange foreign currency transactions, that means Forex, involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you. In light of your circumstances, knowledge, and financial resources, you may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So, folks, just only fund a futures account with risk capital. That means money you can afford to lose without lengthening your retirement horizon or affecting your ability to maintain your lifestyle or pay your bills. Be very cautious when it comes to the use of something that is frequently referred to in our business called day trade margin. All right, there's a lot of leverage present in the futures market. We're going to talk a little bit about discounted margin, i.e. higher leverage today during the event. So just use it gingerly with caution. If you have questions about how it can affect you or your account, please feel free to have a discussion with your representative in our office here about risk. We are certainly happy to have that discussion. We always talk objectively about risk. It's very important to us as a firm. So please feel free to, to have that conversation with whoever it is in our office that you interface with. Okay. My name is Patrick Zielbauer. I'm an AP or associated person of Infinity. Been here for coming up on 14 years now. And as you know, we do these events on a frequent basis, and it's this time again here for Bond Trading Bootcamp with Jonathan. Jonathan has been doing events with us now. I believe we're coming up on a year. We've done several. We have a pretty nice YouTube playlist going with him as well. He's done lots of really cool videos for us that are current. And he is going to talk about his method of bond trading, which you're going to probably hear the phrase relative value, a few times throughout. This is a different way of looking at the market than most of our clients are used to. So it's a little bit unconventional compared to what our typical customer is doing when they're looking at the bond market. We do a lot of business in the interest rates, so we feel like Jonathan's a good fit for people who are looking for different ways to trade the interest rate futures. So we're very happy to have him. He's a great presenter. He answers questions. He's good with email. He's quick. He reminds us of us in some ways, which we really like. So I hope you really enjoy the presentation. Jonathan, thank you for taking your time out of a busy time in the morning to come do this event with us. And thank you, everybody, for attending at what we know is a pretty busy time in the market. So thanks again, Jonathan. Much appreciated. If you want to go ahead and take it away. I think I may have you muted here. I'm going to unmute you, and feel free to take it away, and you can take the screen as well.
Fantastic. Thanks, Patrick. That was very nice.
Cheers, man.
Sweet. All right, guys. Let me just get just sound check earlier, but you guys can see me okay and see me. Can you guys just see my screen and hear me okay? Yes.
Yeah, looks good here.
Thank you. Awesome. Very cool. All right, guys. Welcome, as Patrick said. My name is Jonathan Rose. And we're going to be talking about bonds. So really looking forward to this. See a lot of familiar names. Can I just get, just for an idea of the room, who on here is clients? Just let me know. I mean, I see, hey, Taya, how's it going? What's up, Scott, Tom, Pete? Awesome. Robert, Robin, Bob. Awesome. Very cool. Okay, I'd say it's probably about 50-50. So this will be a little bit different than other webinars that you've attended, or at least the ones that I've seen. So we'll go through it. I'll give you an introduction. What I want to do is in the kind of belly of the presentation, the middle of the presentation, I'm just going to explain exactly how I look at the bond market, see if it resonates with you. Definitely open to any questions that you have. I know Patrick's also going to be in the background, so if you have any questions about Infinity Futures, Patrick will probably answer them. And if you have questions about the presentation, I'll obviously answer them on here. And Patrick already read a risk disclaimer. So thrilled to be here with you guys. That's me in my sweet home, Chicago. I'll make a bold claim right from the start. I'll show you a trade today for those who are not clients you've probably never seen before. And the only reason I say that is because whenever I presented it, nobody's ever seen it before. It's a different way of trading for the retail trader, but the same way that this is going to be different for you, how I see retail traders trade is very different than what I'm accustomed to. What I'll show you today, a unique approach to trading bond futures. I really don't like to speculate. I don't want to guess on direction. I just want to trade what I think is value. And I'll show you how I find value in the market. I think this is the correct way to trade bond futures. If you go to the CME website, this is how they teach how to trade bond futures. We're looking to value the entire yield curve, 2s out to 30s. I always like to say this because I see a lot of webinars. I see a lot of people just presenting on the same topic. Many people say, oh, trading is so easy. If you just do this, then you're going to have great results. Okay? Trading's a profession. So just like your profession, it needs to be learned. Okay? Real estate brokers, mortgage brokers, accountants, I'm not going to learn your profession in 3 days. You're not going to be, a great profitable trader in 3 days. It needs to be learned. You need to put your time into doing it. Many people just bounce around going for the next shiny object or the next great indicator. Like anything worth doing, it does need to be learned. Really appreciate everyone coming out today. I don't think I've ever done a 10 o'clock webinar, so this is kind of cool. The trade, it may seem unique, it may seem different, but don't think like that. It's only unique because you've never been exposed to it. All I ask for today is keep an open mind. If you trade bonds right now and you're killing it, that's great. I'm not asking you to change anything. I just want to educate you a little bit more about how the bonds push and pull off one another. And if you're killing it on your own, I think this will really benefit you as well. Give you a little background for those who've never been on one of my presentations. That's what I'd want to know. Who is this guy? Grew up in New Jersey, moved to Chicago in '97 when I graduated school. Went to the University of Miami, which unfortunately they're already out of the NCAA tournament. Started in '97 as a floor trader at the Chicago Mercantile Exchange. From '97 to '03, I traded NASDAQ and S&P futures. In '03, I was recruited to a new firm that was starting. That firm traded bond futures. I didn't know anything about bond futures. I came from the S&Ps and from the NASDAQ. When I went and talked with them, I was really interested. It was a different approach. It got me really excited. I was the 6th employee of that firm, and from 2003 to 2010, we grew from 6 employees up to 200 employees with over 100 traders, and we sold that firm in 2010. At that time, there was 4 directors, operations, tech, the general partner, and the director of trading. I was the director of trading. So my job at that firm was to manage the entire position, to manage the firm's position. How proprietary trading firms work is you're trading the firm capital. Traders come in, they trade the firm capital, but overall, those firms, if you net them all out, there's one big position. That's what I did. I managed the big position on top. After that, I took a year off. I was under a non-compete, which is the silliest thing ever, but they paid me for a year not to work. Did the Ironman. I like to do endurance events. And after that, in 2011, I became an options market maker on the floor of the Chicago Board Option Exchange. So what I specialize in, what I trade, what I'm really comfortable in is bond futures and options valuation. And I have a commitment to my clients that I only teach things that I've traded professionally. Chicago. Moved to Chicago without knowing anybody. Met my beautiful wife. Had 2 kids. I'm staying in Chicago. So I didn't really know very much about the retail education space. In 2015, the end of 2015, I was just messing around on YouTube watching some videos, and I came across some trading videos. Started looking up some bond futures videos to see just kind of what people were doing. And I was shocked. I couldn't believe the videos that I was watching. I couldn't believe just the lack of quality in those videos that I was watching. And the more that I watched and surfed around YouTube, kind of the more frustrated I would get, the more angry I would get. And that's when I noticed a really unique opportunity for what I consider to be real education. I see these webinars and everybody's just teaching the same different things. Breakouts, trading off of double bottoms, trading off of these different triangles. For those who are, for just perspective, when you trade off something like a double bottom, you need to think, how long would it take for me to explain to my 8-year-old what a double bottom is? But yet people are willing to risk their hard-earned money on something that's just so simplistically straightforward, okay? It's a little bit more in depth than that. That's why I always want to say to clients that take your time. It's not going to be learned in 3 days. I could teach you how to trade a double bottom in 3 days or a head and shoulders in 3 days, but probably not going to be the best path. Love this quote. Risk comes from not knowing what you're doing. Spend some time and learn. I talk to my clients. I have many clients who have been on 50 webinars, 50 hours, chasing the next shiny object. Get off those webinars, find something that works for you, and spend some time really learning it. Let me zoom here and I'm just going to zoom here and get into the trade. Last time the Fed moved interest rates from 03 to 06, they moved them fast. During that time, there was a 425 basis point rise in only 36 months. Right after that, the Fed lowered. When the Fed's moving, they're pretty much telling you which way the front end of the yield curve is going to go, what the rates of shorter term bonds are going to be. So it becomes, a somewhat predictable trade. Right now, the Fed's moving. Pretty exciting time to be involved with bond futures. Okay, when they're raising, notice how this is the 10-year contract, trended lower for 3 years, and when they switched, it reversed really quickly. When this happened, I was trading so many bond futures, the Chicago Mercantile Exchange was flying me all around to their best events. So I thought, what were kind of like the 3 things that people need to learn when trading fixed income? The first thing, bonds are a puzzle. We need to learn to put that puzzle together. Next, being in the right bond is key. If you think rates are going higher, or if you think rates are going lower, cool. If you think rates are going higher, prices go lower, well, it's really important to be in the right contract. So should you sell 5-year? Should you sell 10-year? Should you sell 30-year? Too many, when they're trading, they'll buy, they'll sell, they'll buy, they'll sell. It's like those who trade S&P futures. They spend the entire day trading it from both sides. When I'm trading, I want to take one side out of play. There's a good analogy. I'm a golfer, and Jack Nicklaus used to say that he hit the ball left to right. Every time he hit the ball, he would hit a fade, a left to right shot, and he did that because when he wasn't playing well, it would take the left side of the golf course out of play. When I'm trading, I want to take one side out of play and only look for opportunities. For instance, right now, I think the back end of the yield curve is too low in yield, too high in price. So I'm only looking for places to sell the back end of the yield curve. I have no interest in buying. Even if it goes down really, really fast and hits that double bottom or hits some main support, no thanks. Just trading it from one side. Once learned, this is potentially a very consistent approach to the markets. Give you a little explanation of why interest rates and bond prices move in different directions. Okay, when interest rates go higher, prices go lower. And let me use the example of a 30-year bond. Let's say a 30-year is at 3%, which it is. If I want to buy a 30-year bond and I put $1,000 in, I get 3% for 30 years. At the end, I get my $1,000 back. But if the 30 years shoots up to 10%, in just a silly example, right? It's not going to shoot up to 10% tomorrow. If it shoots up to 10%, I still own that 30-year bond and I'm only getting 3%. How am I ever going to get rid of that darn thing? Well, the only way I'm going to get rid of it is if 30 years now yielding 10%, that $1,000 price plummets to like $200 or $100. So I could sell my 3%, but I'd give it to somebody at $100 and it matures at $1,000. Okay, so that's where they're going to pick up their extra yield. They're still getting 3%, but now they're in from 100 and it expires at 1,000. Oh, Ma, thank you. That was very nice. So let's get into the bond puzzle. As Patrick mentioned earlier, we're going to be talking about relative value. Now, relative value, I've come to learn, is a foreign term to many retail traders. But I don't think it's as foreign as many people think. When I trade relative value, I'm looking at one instrument against another instrument. I look at two correlated instruments, and when their relationship breaks down, I want to buy one and I want to sell the other. Relative value is something that we all use in our everyday lives, right? If you're going to buy real estate, if you're going to buy, a house in New York City versus a house in the northern woods of Wisconsin, where real estate's considerably cheaper than New York City, if you're going to buy in New York, you're going to value those homes or those apartments, whatever, relative to other apartments, probably in the same area, right? You're not going to look at New York and value that against the northern woods of Wisconsin, nor are you going to just go buy an apartment without looking at other comps in the area. Whenever we buy anything, if you buy a phone, you don't just go out and buy the new Apple phone. You might look at what does this offer that the 7 doesn't offer if you're buying the iPhone or the 6. Everything we do is relative to something else. But in trading, people look at things in isolation. That just doesn't make sense to me. One of my members made a great analogy. Rather than using the rubber band where things pull and come back together, he used the analogy of throwing a rock in water where all the ripples eventually subside. That's what we're looking for. We're just looking for a break in correlation. So I'm going to use an example of diamonds rather than bonds. Let me also throw in, I don't know anything about diamonds. I just think it's a good analogy. So let's say right now we have 99 people on here. Let's say we all go to a flea market together. It's a one-day flea market. That flea market only sells 4 things. A 1-carat diamond, a 2-carat diamond, a 3-carat diamond, and a 4-carat diamond. When we walk in there, these are the prices. 1,000, 2,000, 3,000, 4,000. It makes sense, right? As you get bigger, the price goes up. Should the 2-carat trade under the 1-carat? Probably not. That wouldn't make very much sense. Maybe at any given time, based upon supply and demand, it might. But overall, the 2-carat is going to be more expensive than the 1-carat. let's say 5 hours into our day at the flea market together, the prices change. Later on in the day, the 1 carat's still trading 1,000. There's not a lot of demand for that. The 2 carats up to 3,000. The 3 carat hasn't moved. The 4 carats up to 9,000. We may look at that and say, wow, there's a lot of demand for that 9 carat, or for the 4 carat. If we own some of those, maybe we should sell some of those and invest in the 3 carat or invest in the 1 carat. The point is, the 4 carat's not going to keep going higher and higher and higher while the other ones go lower and lower and lower. Unless, I guess, there's just not very many of them in the world. But I think you guys understand what I'm saying. It's all looking at things relative to one another. But instead of doing that with diamonds, we're doing that with the yield curve, with the liquid contracts on the yield curve. And that's going to be the 2-year ZT, the 5-year ZF, 10-year ZN, ZB is the 30-year, and the Ultra is going to be the UB. We want to look at things relative to one another. So right here, if we're looking at the ZF, the 5-year, the ZT is the 2-year, and the ZN is the 10-year, we want to look at them against one another. Because if all of a sudden a big hedge fund gets a margin call, okay? Maybe Patrick calls a major hedge fund and say, listen, you guys ran out of money, you got to get out. And they're holding 1 million ZF. So they're like, oh, darn it, market order, sell 1 million ZF. What's going to happen? The ZF is going to get smushed. ZF is going to go down. That doesn't mean the 2-year is going to go down. It doesn't mean the 10-year is going to go down. So what bond traders do, at least this is what we did with the bond futures firm, in an instance like this, traders looking for opportunity, they might buy the ZF as it comes off because there's a major seller, and they could buy the ZF because it's off value compared to the rest of the yield curve. They could also buy the ZF and maybe they sell the ZN. And they have a relationship trade between the two. And they expect the ZF to rally, or maybe the ZN and the ZT go lower because the ZF happens to be the correctly priced instrument. That's what we're looking to do. We want to keep things nice and simple. I'm not speculating on direction here. If you notice, we're just looking at the difference between the neighbors on the yield curve. If you look at the 5-year and the 10-year, those two have a correlation of about 85%. Is it possible for the 5-year to go down every day for the next 5 years and the 10-year to go higher every day for the next 5 years? It's possible. It's supply and demand. Anything's possible. Is it probable? Probably not. What I want to do now is I want to pull this up and I'm going to draw a little bit because I think it's a great way to kind of explain the trade. Okay, so same thing, we're going to look at the yield curve. Okay, and if we look at the yield curve like this, 2s, 5s, 10s, 30s, and we're going to call these UB is 30 plus. These are the futures. Now the 10-year future, it's really a 7-year, it's really 7 years. The 5-year is really a 4-year. The 30-year is really an 18-year. Okay, so when you're comparing those different instruments, the less difference there is in duration, the more reliable that spread is. So if you look at the yield curve like this, the difference between 2s and 30s is going to be more volatile than the difference between, again, in a silly example, the 4.5 and the 5-year. Even though there's no 4.5-year future, if you look at the difference between 4.5 years and 5 years, those are really darn close to being the same thing. The 2s against 30s, because there's so much time between those two instruments, they're going to be more volatile. So what we're looking to do is we want to trade the neighbors. We want to trade the ones that are right next to each other, because from experience, that's the best way that I found, to really kind of reel in the movement. So 2s, 5s. Give you a couple color references. 5 10s. 10s, 30s. And then 30 UB. So we want to trade all these different spreads. What I want you to notice, and let me just change that color there so they're not all the same color. Okay. So let's go 5s, 30s. 5s, 30s. We can look at that spread on a chart. We can chart 5s, 30s. 5s, 30s is made up of two different spreads that we could trade. Okay? It's made up of 5s, 10s. And then it's also made up of 10s, 30s. Actually, let me just get this. I want to make this more. Is this clear, guys? Are you guys following along? Okay, 5 10s, 10s, 30s make up 5s, 30s. Okay, here's 5s, 30s. This might be a better way to do it. Yeah, let's do it this way. 5 10s, and then it's 10s, 30s. Okay? We're just looking at a little piece of the yield curve. 5s, 30s is 5 10s and 10s, 30s. Now, let's say 5 10s goes way up here, but 10s, 30s doesn't move at all. I'm sorry. So let's say 5s, 10s goes way up here and 5s, 30s doesn't move at all. We know that 5 10s plus 10s, 30s equals 5s against 30s. So if that's the case, if 5 10s rallies all the way up here and that yellow line doesn't move, the 10s, 30s needs to go lower, because we know definitively that this plus this equals this. Okay, just looking at spread. So don't get too caught up in price or yield or whatnot. Right now, we just want to look at the different at these spreads and understand it kind of conceptually what's going on. Okay, so again, if this is 5s, 30s, fives, 10s, tens, 30s. So if 10s, 30s drops all the way down here, but that green line doesn't move, then that blue line, it needs to be up here. And so when that happens, this line is probably too high and this line is probably too low. And that's what we're trying to do, okay? This trade does need to be learned. I wanted to kind of draw it out for you like that, just so you can kind of see where it pushes and pulls off one another. But then we go back to the yield curve and we're looking at things all relative. So again, we might see this 10-year get expensive. You could sell the 10-year and buy the wings. Or maybe you just think that 10-year is expensive, like a little kind of kink in the yield curve is what we called it. Okay? So someone's saying, so the spread goes up and the other pair should go down. What should happen to the US dollar? Don't know. We're not looking at the US dollar. We are looking at a very, very specific example right here. Okay? Don't worry about correlations to the US dollar. Don't worry about how does that affect S&P futures. Okay? Al's saying, does using futures to trade this have a limiting factor due to time, where you can be right on direction, but not on timing? Al, no, because it's very, very, very easy to roll futures. I put here 2016, the yield curve, and the yield curve at the end of 2017. Right now, the yield curve is flattening, right? It's on the front page of every newspaper. The yield curve is getting very, very flat. And what that means, the difference between 2s and 30s is getting smaller and smaller. So if 2-year was 2% and 30 was 10%, the yield curve would be very, very steep. If 2s was 3% and 30s was 3%, the yield curve would be dead flat. Look at the difference in the yield curve right now. Okay, 2016 and 2017. The Fed is moving. The Fed's moving short-term rates. The Fed's going to continue to move short-term rates. So what's going to happen is we're going to see all the short-term rates way up here. Okay? When that happens, the back end of the yield curve, unless we're going to be in a dead flat yield curve, needs to rally in yield and go lower in price. Okay? This trade is taken directly from the Chicago Mercantile Exchange. These are the implied treasury spreads. The implied treasury spreads are shared from the Mercantile Exchange. This is exactly what I'm teaching. Okay? I'm teaching you how to use the information provided from the Mercantile Exchange in order to trade. And if I go back, you could look at all these different spreads have these names. So 5-year, 10-year is called the fight. 5s, fight. 10-year, 10-year, fight. That's why it's called the fight. The knob, notes over bonds. Knob is notes, bond is bonds. Okay? When I first started sharing this with people, I was the only one on the internet that I could find who teaches this. Now, because of the interest, there are other people teaching this, but just be careful, okay? A member sent me a clip of someone trying to teach this, and the clip said, oh, this member just made 11 grand trading the FIT. The FIT's such a good trade. Obviously, that guy's got no idea what he's talking about. The FIT, it's 5s, 10s. It's the fight. Be careful, guys, okay? These are the different spreads. Here's the tough, here's the fight, the 10-year, 30-year is the knob, and here's the bub. And then what we do is we're able to chart these using Sierra charts. What this is the 10-year butterfly, okay? I put a ratio in here to get the right factor for the butterflies. This needs to be learned again. I work very closely with Patrick. I share all the charts with Patrick so we can design these butterflies for both of our clients. This is the 10-year, and then this is going to be the 30-year right here. Here's a 30-year. So 30-year going back to February 15th. When the 30-year is low like this, that means the 30-year is inexpensive relative to its neighbors on the yield curve. So if you think prices are going to go lower and yields going higher and you want to sell something and the ZB is right here, I strongly suggest you consider not selling the 30-year, because this chart definitively shows that the ZB is inexpensive relative to the 10-year and relative to the UB. So if you wanted to sell something in an outright trade, don't do the ZB here. You'd want to sell the UB or the 10-year. Okay? And again, this is on Sierra charts, and I share all these with Patrick as well. Boom, boom, boom. And this shows, what I show here is the touch is made up of yellow and blue. The fob is made up of blue and the green. So we want to figure out the value of the bigger piece of the puzzle, and then we can figure out the components and see what's off value. That's really what we're looking to do. Okay, let me also add, after I take a quick drink, I reached out to Patrick and Infinity a little over a year ago. And I was looking for a relationship that would be beneficial to my clients. And let me pull up this thing one more time, because this is going to be really important. If we do a trade and we do a ZB against the UB, and let's say we buy one and we sell one, we're doing a relative value trade, trading the difference between those two instruments. If you trade through another platform, say you trade through Thinkorswim, if you look at the margin of this kind of trade, and I'm going to estimate, but I'm going to be within 10%, the margin is going to be about 5K and 5K. So it's going to be a $10,000 trade. Very prohibitive, right? That's really, really expensive to do that trade. But the reason it's so expensive on a platform like Thinkorswim is they don't specialize in futures. They're probably more into options. Sure, they'll fill futures, but they don't specialize in that. So this basic trade is going to be $10,000 worth of margin. If you trade through someone who specializes in futures, like Infinity Futures, they're going to use exchange guarantee, what's called spam, which is they're going to give you offsets because they're recognizing the correlations. Actually, the exchange is recognizing the correlations, and then Infinity is recognizing the exchange's correlations. So for Infinity, your long ZB, your short UB, because these are correlated 85% estimated, the margin is going to be about $1,500. Okay, again, give or take 10%. I don't know the exact margin to the tick. Patrick can definitely help you with that. But that's why if you're trading futures, you need to be with someone who specializes. Okay, and so again, I trade bond futures and I trade options. When I trade futures, I am fully supportive of Infinity Futures. I send all of my students over to Patrick. For one, we talk all the time, and I'm constantly going back and forth about the ratios and sharing the charts, but it's also directly beneficial to my members. So that's why that's the only platform that I'm going to suggest. For options, I don't suggest any platform. It doesn't matter. They're, dime a dozen. They're all kind of the same thing. But you can see paying $10,000 versus paying $1,500 for a trade, that is extremely different. Homera, Patrick, will you reach out to Homera? She's one of my coaching clients. So if anybody wants to talk to Patrick, just throw it in the chat. He'll get back to you, but it is an absolute no-brainer. But many don't realize the difference, okay? Al saying, is it only beneficial for students because of the margin? Al, I don't understand the question. Is Infinity only beneficial because of the margin, or is this trade only beneficial? This trade is how you trade bond futures. For instance, when I was with the bond futures firm, we have over 100 employees. If somebody walks into the bond futures firm and is being interviewed, and they say, I trade ZB, I make this amount of money, and I trade ZB, and I look at the Ichimoku cloud combined with Gann and Fibonacci, we're not interested. Who cares? There's a right and a wrong way to trade. The way that we trade is the way that the Mercantile Exchange teaches you how to trade fixed income products. If you're just trading ZB without looking at the rest of the yield curve, you're at a significant disadvantage. So that's my little spiel on Infinity. I am not affiliated with them at all, okay? Patrick might give me a fist bump if I send him over somebody, but I'm not incentivized in any way. I'm just incentivized because this is a really great trade, but it makes sense if you're using a broker like Infinity that gives you that exchange traded margin benefit, okay? Any margin questions, guys? You could throw them up. Patrick's going to be answering them for you, okay? Al, does that answer your question? Prasad, ZB and UB are positively correlated. So when you're buying one and you're selling one, you're just trading the difference. Okay? Usually at this point of the presentation, people feel three different ways. So just for fun, guys, let me know what do you feel? Is it a 1, 2, or 3? 1, blown away. They feel it's exactly what they're looking for. They recognize that it's going to take a little bit of time to learn, but this is what they want. 2 is going to be interested. I like it. I don't get it, but there's something there. And 3 is going to look something like this. Completely overwhelmed. Like, Jonathan, what the heck are you talking about? What do you think, guys? 1, 2, or 3? Awesome. A couple of 3s, a couple of 1s and 2s. So Peter is saying, I'd like to see the profit potential. That's a tough one to answer, Peter. What I tell my clients, if you have 10 people doing the exact same trade, how many results do you think you're going to get? And let's use another analogy. You're going to get 10 different results. Okay? Every single time you're going to get 10 different results. I could take my kid. I have 2 boys. Earlier I talked about my 8-year-old. Now I'm going to talk about my 11-year-old, just to be fair. I could take my 11-year-old to a lesson, a basketball lesson, and he can learn about shooting foul shots. And for an hour, he can listen. And then after, I could say to the guy, okay, cool. You just gave my kid an hour lesson. What percentage foul shooter is he going to be? That's the same question for trading. I don't know. How good of an accountant are you going to be? How good of a real estate broker are you going to be? If Patrick hires somebody to work with him, how good of a rep are they going to be? Everyone's different. If you put your time in, I think you'll realize this is a real trade, and it's very different than you've ever been exposed to. Okay? How long is the typical trade? Hey, Phil, how's it going, buddy? The typical trade can be anywhere from a short-term trade that might be 30 minutes to 2 weeks. It depends on how you trade it. If I'm just trading outrights, which is just not trading spread, you still need to analyze the yield curve to always make sure that you're selling what's expensive and buying what's inexpensive. If you're going to be trading spreads and you think on a longer term, well, for you, those trades are going to be a little bit longer. I always think it's important for traders to find their, trade with their DNA. What works for you? Some people like to be shorter term. Some people like to be longer term. I'll tell you from personal experience, when I trade options, I'm extremely patient. I make a decision, I put risk on, and then the market's going to do what the market's going to do. I don't care. When I trade futures, I have ADD. I don't know why. It's just futures. I want to see something happen fast. For those that are impatient, the 2-year, 5-year, those are going to be slower trades. That might be a better fit for you. For other ones, if you want something faster, the ZV or the UB, those are going to be better for you. Al is saying, is it more lucrative to trade it outright with a spread methodology? Okay. This is kind of in, I don't know what's more, I don't even know what that means. Is it more lucrative? This is the correct way to trade fixed income contracts. Just getting a lot of questions now. Let me finish going through. I got another 10 minutes for you, or 8 minutes. Let me tell you how the bond program works, and then I'll stay on for as long as you need, answer any questions that you have. So I try to make the bond program pretty straightforward. Okay, I have 2 different parts of the bond program. I have a foundational course, and then I have an advanced bonds. That's it. So foundational course is called Bond Bootcamp. After that, I have advanced bonds. Advanced bonds is by application only, and I need to speak with you if you're looking to get into advanced bonds because it's a bigger commitment. Here's how the foundational course works. You get Bond Trading Bootcamp. Level 1 is all about outright trades. Level 2 is spreads. Level 3 is going to be valuing the yield curve, getting into some more advanced topics. I also include bond specs, margin, contract info. Always reach out to your rep, though. Patrick's going to be a much better guy to help you with any margin questions. So you're going to get 4 hours of training that's all about this specific trade. Bond Trading Bootcamp, I don't really know what the value is. I really don't see anybody else teaching this. Okay, so you'll get that. What you're also going to get is something called Fed Dominator. And what this is, it's a 90-minute workshop that explains to you how to put together the butterflies. Okay, anybody who's in Bond Bootcamp, I'm going to share with you all the butterflies anyway, but it's always important to me to teach you guys how to fish rather than just to spoon feed you. Here's what the butterflies are for the June ratios. I send this out to all Bond Bootcamp people anyway. Okay, so overall you're going to get the Bond Trading Bootcamp. Oh, actually, so this is 3 hours and this is 90 minutes. So it's 4.5 hours of training teaching you exactly how to do this trade. What you're also going to get and I'll show you exactly what this looks like, is going to be, once I find it. This is something I just recently started doing. This was for advanced bonds, but we decided to give this to Bond Bootcamp. So I want to pull it up and show you exactly what it looks like. It's a 20-page PDF, and it was actually designed by one of my members who just wanted a better understanding of the trade. And I said, wow, that's pretty awesome. We should give this to everybody. So here's what it looks like. This was made by Stephen Williams, who's also a client of Patrick's. And this is 20 pages that will walk you through the trade, okay? We threw some questions in here. You're always welcome to reach out to us to answer any of these questions. There's different exercises. We want you to learn how to do the trade, okay? This doesn't work if you're just gonna watch the video and never go back to it. We want you to really learn how to do the trade. So that's why the 20-page futures PDF is gonna be included with this. Who's this for? Futures traders. Infinity Futures, I think it's only like $3,000 to open an account with these guys. And you could paper trade on Sierra charts. Whenever I work with new clients, even in my coaching clients, guys, for a 6-month coaching program, I require everybody to come in and paper trade for at least a month. Take it slow. There's no rush. Prove to yourself that you can make it work on paper. Have a goal. I want to make $300 this week on paper. If you can do that, have a goal. I want to make $600 next week. Once you graduate from that, then trade live. Don't trade live before you know what's going on. Okay? The market's not nice to people who don't know what's going on. So if you want to learn a really unique trade, if you're trading bond futures, this is for you. It's not easy. I'll tell you that from the start. You got to be willing to do the work. But if you're 100% committed to making trading work, I think you'll really enjoy this program. Always like to say, you got 2 choices. Continue doing what you've been doing. Don't make changes. Ignore this advice. Finally, you can act on this information. We can start working on this. So for those interested, this is going to be $297 to learn something that you really can't learn anywhere else. You'll get the 4 hours of content, the Bond Trading Bootcamp, the Fed Dominator that teaches you exactly how to put the butterflies together, and you'll get that tool, the PDF that Stephen built, the 20-page PDF. This 10-page PDF also comes with it. What that shows you is the exact levels that the bonds were trading at between 2003 and 2010 when the Fed raised rates and when the Fed lowered rates. Okay? For anybody who has Bond Bootcamp and who does not have the PDF, like Mary and Tom who just asked, I'm going to send it out to you, absolutely. Okay? You guys will also see about half the room right now are already bond students. So they're just coming on to reinforce the education of the trade. So I got one more thing for you guys, because I love being with Infinity Futures. These guys have been so good to me, and being with Patrick and I just have a really strong relationship, and it's worked out for the clientele. So for anybody who decides to move forward and who's with Infinity, you're also going to get a live class. We'll do a live class in early April. I'm going to talk to Patrick because I'd like Patrick to be on there as well, where I'll present for 45 minutes or 60 minutes about the trade, and then Patrick will be on there for as long as he needs to help you with any of the margin questions or setting up charts or anything with Sierra charts. I didn't even tell Patrick about this, but hopefully, Patrick, this is cool. We'll do this together sometime in April. So that way, for $297, you guys are learning the trade, start building that foundation, and then we'll do a live class and everybody can kind of hang out, ask some questions, and really get comfortable with the trade. Finally, before I get into these questions, guys, there is a 30-day money-back guarantee. Okay? If you don't like the sound of my voice, if you don't like the fact that I'm from New Jersey, you can return it at any time. This is being recorded, saying this in front of Patrick, so there's no, for your comfort. If this doesn't work for you, this does not work for me. Okay? 30-day money back guarantee. So that means you pretty much have zero risk in this program, not in the trade, in the program. Finally, I'm here to help. Email me. As Patrick said in the beginning, I'm a quick reply. When traders have questions, traders need answers. In no way am I just going to give you a 20-page PDF and 4 hours of information and then say, ABC later. That's not how it works. Okay? Anybody interested? ActiveDayTrader.com/Fed. And now I'll start going through all the questions. Okay? FYI, guys, if you're members asking specific questions about the trade, I'll reply to you guys individually over email. Okay? I will send the PDF to all Bond Bootcamp students. Tom's awesome. Tom's asking a question about the margin for the butterflies at infinity. Patrick's going to send him that information. So if anybody else would like that, just put your name in there and your email address, and Patrick will personally reach out to you. Hey, Jet. No. So the Dominator, the PDF, this all comes for $297. You're good. So all these come with $297. The way the bond program works, again, there's the foundational course, which teaches you everything. And then I have advanced bonds. The way that advanced bonds works, and I'll show you this, I think, when I present with Infinity Futures, guys, they're under a different regulatory status than I am. So just FYI, I'm getting a question now. Do any of your customers here have any comments about your service? Al, I asked Patrick if we could broadcast these questions to everybody, but I don't think we can with GoToWebinar. I'm not sure how I can answer that question now. Do any of your, my customers are on here. Customers, you can say something, but I don't think I'm allowed to repeat it. Victor, should that lead? Why is it not working? Is anybody having problems with the link? Let me just make sure that link is working for you guys. And this /Fed. You got buy a t-shirt. Okay. Just email me at support at Active Day Trader. Oh, because I did the wrong one. Fed. Holy cow. Just email me, guys, support at Active Day Trader. Okay, well, that's very sweet. I don't think I'm allowed to say that, though. I think Patrick would put me in the penalty box. So advanced bonds, guys, I'll show you how that works. Advanced bonds, we have a Facebook community. Here's the Advanced Bonds Facebook room. If I can get the darn thing to load. There we go. So here's what that looks like. Sorry, guys, internet connection's slow. Can you guys still hear me okay? Yeah. Okay, good. I was just thinking that I'm having problems with the internet connection. I didn't know if you guys were, if I'm losing you too. There we go. So there we go. You know, this is how it works. Sent this an hour ago. Now we're just talking about trade management. If you're just short a ZB, if you're short 3, consider covering 1 and holding the balance. If we rally, then you sell 2, build into a position. Okay. See, it's pretty active. It's just an article that we shared earlier. Watching the Knoll. The Knoll is going to be 10-year against UB. As soon as that rallies, we're looking to get long the bow. Okay. Mary, so the Facebook room is for advanced bonds. If you don't do Facebook, it's kind of crazy. I've had many people come into advanced bonds who have never been in Facebook, and you can totally just open an account or just get a different, use a different email address, get you in that Facebook, in the advanced bonds room, and then nobody will ever know you're on Facebook. So you can just use Facebook for that. Okay. So there you go, activedaytrader.com/Fed. If you're having, very funny. If you're having any issues, just email me, support@activedaytrader. I'll throw that in the chat. And we'll get you started right away. Sorry for any problems with the link. I don't know why that's happening. Okay. Did I miss any other questions, guys? I know there was a bunch of questions coming through when I first started introducing advanced bonds. So if you didn't get your questions answered, if you could put them back in, that would be great. Oh, Larry, cool. Thank you, buddy. Just reach out if you have any, Larry, if you have any questions, just reach out. Okay, just support it, Active Day Trader. Yeah, you got it. Al's saying, in general, are some spreads more lucrative than others? Al, more of it's, in general, are some stocks more lucrative to trade than others? Right? You know, that's not a question. So the problem with that I found with this industry is you're going to get a lot of people who just BS you, right? I can't give a real answer to that, so therefore there's no answer. Okay, this trade needs to be learned. If you're trading futures, I think it's a really great trade for you, and you guys are already part of Infinity, so it's, you know, really synergistic with exactly what you're doing. There's also a 30-day return policy, so that gives you that cushion. But as far as are some spreads more lucrative than others, or how much money that you can make, that's everyone's different. Everyone's different. I don't know. I've had some clients, or one client who told me that he goes on a run and listened to one of my classes, you know, like 20 times. You know, it's different. Everyone's got a different learning curve. Everyone's got different experience. When you're in a trade, are you nervous? Are you covering too quick? How are you at trade management? How are you at managing your futures against the rest of your portfolio? There's so many variables. So whenever you're doing what's up, Bill? When you do like a ZB-UB, whenever we talk about buying, you're buying the shorter duration and selling the longer term duration. So, Al, when you're it's like trading. Al's followed up the question saying, when you're trading Amazon versus GE, Amazon has more movement. Right, but if you're trading Amazon versus GE, you have to normalize them. So part of trading Amazon versus GE in this example, even though they're not correlated, you would need to figure out through correlation analysis what the ratio is to trade those two, so one doesn't move more than the other. Okay, I can't, again, guys, anything to do with returns, somebody is going to BS you. Okay, everything needs to be learned. What's the percentage of my kid's going to shoot foul shots? No clue. It's up to him to do the work. Okay? Any other questions, guys? Email me, support@activedaytrader. If you have any questions about margin, just reach out to Patrick. You can reach out. It's PZ@Infinity Futures. That's a great way where you don't have to go try to spell his last name. Okay? Thank you guys very much. I really appreciate being here. Patrick, thanks, buddy.
For sure.
Always a good time.
Yeah, for sure. Thanks, Jonathan. I appreciate it too. Thanks for taking the time to do it. Folks, for those of you who are already customers or who are wondering if this is something that you'd want to explore, one thing that I will say is that if you are the type of person who likes to participate in this type of trading, but you are over trading, and by that I mean, you got 5 or 10 grand in the account and you're doing, 20 to 80 contracts a day trying to scalp the market, and you find yourself burning out. This might be a nice way for you to stay involved without having to sit there and be going crazy all the time. I mean, we appreciate the trade volume, but we're in this for longevity. We want people to be around a long time, refer their friends, their colleagues, stay interested. We don't want to play the short game. So there is, it is true that trading spreads is not necessarily less risky than trading outright contracts. In some cases, it can actually be more risky. That is also true. But for those of you who are actively day trading your account, where you're very, very active, I don't personally believe you would feel like you're taking more risk by trading this way than what you're already doing. So if you need to slow down a bit and kind of reset, this might be a nice way to do that, without dramatically amplifying your risks, and you might reduce them in some cases. Okay, so there's a couple people, Pete, who agree with that. I'm glad to hear that. I mean, that's we're trying to put good information in front of people. You guys know, and gals know, there's a lot of turnover in our business. It's exhausting for me. It's exhausting for you. I've been doing this for 14 years. Like I said, chasing down new customers. I don't want to do it as much. I would love for people to just kind of chill out, follow something that is a little bit more, that plods along a little bit more in, generally speaking, than the hyperactivity of the very, very quick short-term trades, which some people can make that work. A lot of people can't. That's a reality. But if you're thinking about it, that's kind of my perspective on the whole thing and why we're even going down this road. All right. Plus, on top of that, we do the margin thing really well. It just so happens that we do it better than some of our competitors. Boutique shops like Infinity like to make a big deal out of a lot of things they're good at, so you can't blame us for that either. But if you have any questions about the margin, about what it's like to be a client of Infinity, it's a $3,000 minimum to open an account here. Most people can make that work. It's a nice way to get to know us. But the simulator's got 30 days on it. It's live data. We can give you a bunch of these charts that you can work off of. I'm going to take the screen real quick and just flip a couple of these on so you can see, some of what they look like. But we showed a little bit of these earlier, but this is an example of a ZB minus a UB spread that we can give you. It's already pre-made. This one has a bunch of the flies on it. So this is like the ZB fly, the 5-year fly, and the 10-year fly. Up here are some of the other spreads. So like this one here is 6 2-years against 1 30-year. This one is 2 2-years against 1 10-year. This one is 3 10-year against 1 30-year, which is the knob spread. That's probably one of the most popular ones. Also has a very low margin. And then the margin thing we were talking about, I have this spreadsheet that I get every day. It's not very clean looking, but it's got all the data there, and it tells me every day what the margins are. And so like if you look at this one, if you look at this one here, ZB minus UB, this first column is the maintenance column here. This is the number we're generally looking at. So this is 1 ZB minus 1 UB. The 6 means June. 2018 is the year. The second column is just a repeat. I don't know why it's there, but it doesn't go away. And then this is the margin associated with that particular position. So it is interesting for us to be able to see how low the margins are in some of these contracts. And interestingly enough, a lot of them are a good reflection of the risk and the volatility in the market. So as an example, like look at this one here. This is 6 Dow against 5 E-minis in the June contract, 6 Dow against 5 ES. Look at the margin on that position, $9,120. All right, what do you think the margin would be on this trade if you had to margin all 11 of these contracts at full margin without a pair? The margin on these things is roughly 6K a piece. 11 contracts, I mean, you'd have a margin requirement overnight of like $67,000 when the margin really should be less than 10,000. So the differences are dramatic. It's not like, our margins are going to be, 85% of what TD's margins are. Some of them are like, it's like 1/5 or 1/6 or less of the margin. It just becomes a question of efficient use of capital. So something to seriously, consider. So we appreciate you listening. Thank you again. If you have questions, let us know. I'm going to read some risk stuff here. We'll probably have this up on YouTube, I'm guessing, within a day or so. And we look forward to hearing from you. And we'll see you next time. And Jonathan, thank you again for taking the time. Everybody have a great day, a great weekend. And we will see you on Monday. Okay? All right, folks. Thank you very much. Trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, thank you again, folks. Everybody have a great day and a great weekend. See you next week. Thank you. And thanks again, Jonathan.